First of all, welcome everybody. Thank you for our webinar and your participation in that webinar. We are talking about tax simplification, and Rachel Milne is going to be hosting that. I am behind the scenes. I'm the one that sent you all the email. I'm the one that built it in Zoom. I will be the one that is posting it online later. I'm Jason Sleed. I'm in communications here at Department of Revenue, and we have really enjoyed leveraging all of the people who have interest in our material, not just taxation, but any material that's coming out of revenue. We try to tie in with a webinar and get everybody involved and have some people ask us questions specifically to the businesses and the units and the areas of concern in the webinar format, so it's more personable, and I love it. I think it's a great opportunity for us. So welcome everybody. Just heads up, this will be recorded. It is recording now. We will post it on our website. Due to the Zoom company, it takes me about 48 hours, 24 to 48 hours to get it online. So at the completion of this webinar, in about probably 4 to 6 hours, I will get the files from Zoom. I will put them on our website, and then you can watch it again. Maybe you had to skip away, or maybe you lost connection or whatever. I will be sending out a poll to find out what your area of interest of this webinar today. I'll be asking if you are a tax preparer or a state employee, member of the press, that kind of thing. If you could just take that poll, just so we know what our audience is. There's not too much more deep than that. The bottom rail, that's your question and answer. You can ask any questions you want in the question and answer. And we do have panelists that are going to be answering your questions. So I will introduce our panelists today. We have two panelists that are going to be dogpiling your questions. It's Brian Olson, who is one of our tax specialists, and Logan Nordahl, who's our analyst and planning bureau chief. They're going to be making sure that you guys get the right answers in a timely manner. And then that brings us to our host, which is Rachel Milne. She is also our tax specialist. If you've been watching some webinars, she has been doing a lot of the webinars coming right out of business and income tax. She does a great job. And now that she's such a pro, I don't know that she can ever get out of these. So you'll probably see her a lot. But I do want to give you guys all a high five. Like I said, Zoom only allows 500 people, and there's been so much interest that we had more interest than available spots. So congratulations to you guys. So Rachel, without further ado, thank you so much for doing this and spending time with us. Thank you for everybody participating. And when I put out that little poll, please take the poll, because we want to know. Anyway, yeah. Rachel, all about you.
Thank you, Jason. You're always so gracious and getting us started and keeping us on track. I really appreciate that. So today we're going to be talking about income tax simplification for Montana. This is as a result of a bill that was passed during our 2021 legislative session, and we call it income tax simplification. That was kind of the title of the bill. The real bill number, though, Senate Bill 399. Again, that's passed in 2021. Before I get started, I'll just do a couple of housekeeping items. So today presenting Rachel Milne. I'm a tax specialist here with the Montana Department of Revenue in the Business and Income Tax Division. Also, Brian Olson, our other tax specialist, will also be presenting, and he is also in the Business and Income Tax Division. This webinar is going to be recorded, so if you missed something, you can go back and watch it. After the webinar, we'll send a link out so you have access to it. It'll be out on our website. The handout for the presentation is in your chat, so go ahead and download it there. Jason just posted it to the chat. And the handout's interactive, so you'll see at the end of the slides, there will be some links that you can go out onto our website and get more information after this presentation. So back to the meat of the presentation. Jason, would you mind posting that poll? We just want to get an idea of who's here today.
I just launched it, and people are actually taking the poll, which is awesome. And it must have been, I hyped it up so well.
Great, thank you. All right, we'll give it about a minute here for folks to answer. Okay. And again, if you could answer the poll, that would be great, just so we have an idea of who's attending.
So just give you a high level. I don't know if you can see. Can you see the results right now, Rach?
I sure
Or
can.
okay, I didn't know if it was just me or not. I was hoping I
Oh,
was the keeper of all information, but evidently I am not. So
all right.
right
Well,
on.
it looks like majority of you guys are tax preparers or accountants, so um, that's great. We'll have a good starting point for you guys. I'm sure most of you are familiar with our current, well, with our old system, and now learning about our new system. So with that, I'll get started. So like I said, this is as a result of a bill that was passed back in 2021. We like to call it income tax simplification. It's also referred to as Senate Bill 399, which was the bill that was passed to enact all of these changes. Now the bill was passed with the goal in mind to simplify Montana's tax system. The main goal of the bill was to align us more with the federal system and the federal definition of income and deductions. The bill also removed a lot of unused and obscure deductions, and it also removed some deductions that were kind of confusing for taxpayers, or it also removed some deductions in order to pay for the lost revenue from the passage of the bill. So this bill is basically, this is a big bill because it's going to affect how every Montanan taxpayer determines their taxable income. All right, so here is our agenda today. We're going to be covering 4 things. We're going to cover the 6 major changes that this bill makes to our tax system. We're also going to go over the changes to the tax form. We'll briefly touch on changes to estate, trust, and pass-through taxation. And there were some minor transition provisions that happened in the bill. So we're going to go over those as well. So for our first 2 of the 6 changes, I'm going to have Brian cover those.
Thanks, Rachel. The 2 areas of the changes I wanted to be talking about are repealed credits and repealed deductions. On the credits side of it, there is an interim committee comprised of representatives from the various tax committees for our legislature. And one of the tasks that they have is to review tax credits just in general to see if they're still effective, if there's changes needed, and make recommendations to the legislature. As part of their work, some of the recommendations were incorporated into the simplification. And so a fair number of tax credits were repealed as part of this, either because they were, say, no longer effective or addressed a need at the time. Some of those alternative energy systems and that. Another example of why things may have been repealed was they sort of serve their purpose in the energy conservation field as an example, that everything is now highly efficient in that. And so the incentive through the credit they deemed wasn't necessary in that. There were also some changes related to credits because of how they're changing the tax system. And the primary one in that is you may be familiar with the capital gains credit that we've had. That was intended to essentially have an effectively lower rate on capital gains. That has been replaced by lower rate structure. And we'll talk about that later in the presentation and that. So it should be in the notes of the handout, the various credits that were changed potentially or repealed. And I mentioned changed because the adoption credit, which had been $1,000, was repealed as part of this. They did institute a separate bill, but they instituted a new adoption credit. It's a little more generous in that. So you can look into that. So that's one area that you'll immediately see changes is credits in that. For similar reasons, they took a look at a lot of the subtractions, deductions that people were able to claim. And part of that was to simplify things. So they removed the deduction, but then they allowed for, they compensated for that with lower rates. And so things like tips, unemployment, workers' comp, which previously had been exempt from Montana tax, are now included, but with the lower rates and the higher deduction that you'll see by following the federal standard deduction or itemized deductions, the offset, be an offset of that a little bit. There were also some that they looked at and said, hey, this is just not effective anymore or necessary anymore due to Affordable Care Act changes. So that's some of the things with insurance premiums and that. By going with federal taxable income and following the federal filing status, there was not the need for, we were making some changes to compute your Montana taxable income because of how we started. And by going with federal taxable income now, those changes aren't necessary. So net operating losses, there's not a separate calculation to determine your net operating loss for Montana purposes. Social Security, there's not a recalculation necessary of Social Security because that depends so much on what your taxable income is, how much of that then affects how much of your Social Security is included. By going with the federal taxable income, that adjustment isn't necessary anymore. So those are the credits and deductions that you'll not see on your return anymore. But that leads into then, once we getting into, as I mentioned, it's talking about the federal filing status. And so I'll hand that back to Rachel for that.
Yeah. So this is probably one of the biggest changes we'll see is that we're aligning with the federal filing status. And that's important because it's going to affect how your taxable income is calculated. And it's also going to affect how much you're taxed on. So, of course, the federal filing statuses are single, head of household, married filing joint, qualifying surviving spouse, and married filing separately. Now, previously we had single head of household and then 4 statuses for married taxpayers. And the filing statuses were not used to calculate tax. They were only used to determine what your standard deduction would be. The 4 married filing statuses were kind of confusing and they were specific to Montana, and they were all kind of available to taxpayers as an option. Married taxpayers could choose which status they would want to use. So the 4 statuses, we had married filing joint, which for the most part followed federal guidelines. Then there was married filing separate and spouse not filing. This was for non-residents with only one spouse having Montana source income. It was also to be used by residents where the non-resident spouse has no Montana source income. There was married filing separate on separate forms, and taxpayers could choose this one if they wanted to do kind of the similar married filing separate federally. And then finally, there was married filing separate on the same form, and taxpayers used this one if they were both residents, they were both non-residents and they both had Montana source income. This one was it got kind of confusing because income and deductions are allocated to the spouse, and sometimes income can be joint. And so there was a lot of divvying up of income and a lot of accounting and that sort of thing to make sure that income and deductions were allocated appropriately. And just a fun fact, more than 50% of married joint federal filers were using this separate same status. So that also caused confusion as far as how income was determined. Moving on, our filing thresholds are increasing, and that is a result of how that's as a result of just wanting to follow more of the federal definition of income, and also because the tax rates are a little lower than they were previously. There are two new tax tables, and they are going to be broken up by filing status. So this is new for Montana. Of course, our tax table under the old system was just everybody paid the same rate. Everybody had that same rate, regardless of whether or not they were whether or not they were married filing joint, or they were single or a head of household, unlike how it's done federally. Now we've got our tax tables are broken out similar to how they are broken out federally. And we also have a new tax table for net long-term capital gains. And this was actually passed in the 2023 session, rather than having the credit. And then in the original bill, there was a 30% reduction for long-term capital gains. In 2023, the legislature took a different direction and said, let's actually go with a tax table for net long-term capital gains to differentiate them from all other sorts of income, and kind of give the tax calculation on net long-term capital gains the same treatment that it gets at the federal level. And then finally, the bill fully changes how our taxable income is calculated. So these next two slides are our new tax tables. This first slide is our ordinary tax rate. And Montana ordinary income is considered everything that's not a net long-term capital gain. To clarify, this also includes qualified dividends that they do get the federal capital gains treatment. However, with Montana, they will not. It's just for net long-term capital gains. We've got two rates, you can see, and they're all based on your filing status. And opposed to our old system and this is opposed to the old system that didn't differentiate between the filing statuses. You'll also see that estates, trusts, and pass-through entities that elect to file composite tax, they're in the single bracket on the left. Another thing to note, on our old tax table, we had 7 progressive rates. Of course, this new tax table, we've got 2. So our 2 rates are now 4.7% and 5.9%. Another kind of quirk here as a result of the 2023 legislative session. So the original bill had the highest marginal rate at 6.5%. In 2023, they decided to lower that further. So the highest marginal rate is 5.9%. Also, you'll see that the highest income threshold for a single filer is $20,500. And why I point out the single filer is because, we only had one, your tax was determined as if you were a single taxpayer. So this our current, well, our 2023 highest income threshold was $21,600. So income in excess of $21,600 was taxed at 6.75%. You can see that this is a little bit lower than what our income threshold is for 2024. And that has to do with the bill being passed in 2021. And then it's not going to get updated. These numbers aren't going to be updated for inflation until 2025. And they'll annually be updated thereafter. Here's a look at our new table for net long-term capital gains. And this is for the income realized from the sale of assets, such as stocks, bonds, and real estate owned for more than 1 year. These are also based on your filing status. Taxpayers are going to get a lower rate on the sale of their net long-term capital gains only, and qualified dividends are not included here. And they get 2 tax rates unless ordinary income is greater than the highest amount for the filing status. So for example, if a single filer's ordinary income is greater than $20,500, their capital gain will be taxed at 4.1% and won't be subject to that graduated rate of the first $20,500 at 3% and the next at 4.1%. These rates are also going to be indexed for inflation. And like Brian was saying earlier, because we have these rates now, we're no longer going to have the 2% capital gains tax credit. So because our new base for determining Montana taxable income starts with federal taxable income, our filing requirements are also going to conform to the federal filing requirements. With some caveats, which have to do with the Montana specific additions or subtractions that need to be made. So if you don't have a federal filing requirement, but have a specific Montana addition or subtraction, then you'll need to file a Montana return. So for example, if you don't have a federal filing requirement, but took a non-qualified distribution from a Montana medical savings account, for example, you'll need to file a Montana tax return to report that non-qualified distribution. On the flip side, if you do have a Montana medical savings account and make contributions to it during the year, you're still going to need to file, even though you don't have that federal filing requirement, because you need to report how much you contributed to your Montana medical savings account. Under our old system, the filing requirements were based off of our Montana standard deductions, which after the Tax Cuts and Jobs Act in 2017, that those standard deductions pretty much dipped below by about half of what the federal standard deductions were. So our filing requirements were quite a bit lower than the federal filing requirements. And one of the things that means is that under the new system, with this increased filing threshold, there may be taxpayers that no longer have a filing requirement because they don't have a federal filing requirement. And our economist ran some numbers back in 2020 when the bill was, or based on 2020 returns, when the bill was passed. And they estimate that about 86,000 taxpayers wouldn't necessarily have a filing requirement. However, of that 86,000, 70,000 would probably want to file regardless, so they could get their tax credits like an earned income tax credit or their elderly homeowner renter credit, or just claim their wage withholding that they may have had withheld from their paychecks. So that leaves about 16,000 taxpayers that would drop off the rolls. And again, that's using the 2022 tax return data. Of course, a lot of things have changed since 2021 when those 2020 tax returns were filed. So that number may increase based on adjustments and also adjustments made to our wage withholding tables. I'm going to hand it over to Brian to talk about the change to our taxable income that started in this year.
Thanks, Rachel. And I think this slide just kind of illustrates part of what we've been talking about to this point, in that, as you can see, up until 23 tax year, Montana, we started with federal adjusted gross income, but then partly because of the married filing separate option for some couples filing jointly federally, but for other reasons, there were a lot of adjustments simply based on matching up the calculations to the federal, following the federal called for. And then we had a lot of those different adjustments in that. There on the old form, you'll see probably 30 some subtractions and about 15 to 20 additions. And those come from a variety of reasons, but those are the adjustments that we talk about in that second line of that column, or that flow chart on the left there. And then we had our own standard deduction or itemized deductions that diverted from the federal to a certain degree, and potentially different rules about, not different rules, but different application of exemptions and things of that nature. And so you came up with a taxable income through a lot of different steps. Starting with the 24 tax year, we do start with federal taxable income, and then just a very limited number of adjustments. A big part of that is because if we're following your federal filing status for married couples, and so if they file joint federally, it's joint for Montana. And when we get later into it, we'll talk about the impact of that on non-residents or couples with one resident, one non-resident, et cetera, and that. But then you get more quickly to a taxable income for Montana, and even, I would argue, a simplified computation of the tax. As Rachel kind of alluded to, the capital gains, the application of the computation of tax is the same as what the federal is. It's just different rates and different thresholds in that. But that, I think this slide really illustrates how much simpler things will be going forward with that. So.
Yeah, so basically we're going to lose 3 steps because we are starting with federal taxable income. And I just wanted to show a reminder of what federal taxable income actually consists of. So previously under the old system, we started with line 11 of the federal tax return, the Form 1040. Now with the new system, we're starting with line 15. What does that mean? That means that you're getting that federal standard deduction or itemized deductions included in the calculation of where you're starting at with the Montana taxable income. Side note, line 13, that's qualified business income deduction that's available to small business owners. That is actually not included in the calculation of Montana taxable income. It's an adjustment added back. But regardless, it's basically your federal AGI. This is the starting point here for Montana taxable income. Your federal AGI minus your standard or itemized deduction to come to the starting point for your Montana taxable income. One other thing to note, at the end of 2025, the federal government will, the Tax Cuts and Jobs Act that was passed back in 2017, that's set to expire in 2025. If it does expire, that means that standard deductions for federal purposes will decrease back to the old system, the old federal system. It also means personal and dependent exemptions for federal purposes will come back, and those are included in the calculation of federal taxable income. So that's just something to keep in mind. By moving to this new system, we're tied a little more closely to how the federal taxable income is calculated. So with that description of federal taxable income, I wanted to show you how under our new system, we're going to calculate Montana taxable income. So I know we previously, under our old system, on our old tax form, we had taxpayers report everything that was already reported on the federal return. A lot of the reason for that was because we had the separate filing on the same form status. So we needed to divvy up income by spouse and see that that income was divvied up. However, under this new system, we're just going to start with the federal adjusted gross income from the 1040. Then we're going to have taxpayers report whatever their federal standard deduction was or their federal itemized deductions. Now, as part of the federal itemized deductions, state income tax is not deductible for Montana purposes, so taxpayers will need to adjust adjust out any state income tax they took as a federal itemized deduction. And because we're going to follow those federal filing status, that you're on line 2, you're going to be reporting your federal standard deduction for your filing status. Like I said before, you'll notice that we didn't include the QBI, the qualified business income deduction, here on the tax return. It's not located anywhere on the tax return. We just have you reporting federal adjusted gross income minus your standard or itemized deduction to come to your, what we call your federal taxable income for Montana. So moving on, once you have that line 3 amount, you'll make your Montana adjustments. You'll add in your additions from the new adjustment schedule. You'll take out any subtractions that you have from that new adjustments schedule. There's a new subtraction here on line 5. We put it on the front of the return based on the thought that, you know, there are going to be a lot of taxpayers claiming this new subtraction, which I'll go into detail in a minute. So that gets subtracted out on line 6. So you make all of your adjustments, add lines 3 and 4, subtract out lines 5 and 6, and that's where you're going to start out on your Montana taxable income. So since I mentioned that new subtraction, I wanted to talk about this new subtraction as well as one other new subtraction that we got from the 2023 tax legislative session. So this is a new subtraction for taxpayers 65 and over, and it's equal to $5,500. And if spouses, if you've got a taxpayer filing jointly, both spouses are 65 and older, they both get that subtraction. So for 2024, it'd be worth up $11,000, which is $5,500 for both spouses. This deduction is going to be indexed for inflation annually, and it's going to be rounded to the nearest $10 each year. The other new subtraction, which I wanted to cover because it will go into the calculation of Montana subtractions. This is a new bill that came out during the 2023 session. It's for resident taxpayers that are military retirees that have retirement income from service in the military, and they also earn income from working a job, running a business, or operating a farm in Montana. It's also available for beneficiaries receiving military survivor benefits. The retirement of survivor benefits had to be from service in the armed forces, the Army National Guard, the Air National Guard, or a U.S. Reserve component. The subtractions equal to the lesser of 50% of the taxable retirement income from the military service, or all of the income received from working a job, running a business, actively running a business, or operating a farm. And then for the beneficiaries, they don't have the work requirement. The subtraction is just 50% of their taxable benefits. The subtraction's only available for 5 consecutive years. And if the taxpayer becomes a non-resident after having taken the deduction, they're no longer eligible for it if they reestablish residency. There are certain residency requirements with this subtraction. The taxpayer must have been become a resident after June 30th, 2023, or they must have been a resident before receiving their military retirement or survivor benefits. So a couple examples of how this will work, because the residency requirements are a little confusing. So Sarah retired from the Army and became a Montana resident in August of 2024 to begin working a job in Sydney. She can take a subtraction of the lesser of half the taxable amount of her military retirement, which she received while she was a resident, or all of the Montana source income from working that job in Sydney. So it's the lesser of half of the taxable military retirement she received while she was a resident, because for 2024, she's going to be a part-year resident, or all of her Montana source wages. Another example for a person, the next two examples are for taxpayers that are residents before June 30th, 2023. So we've got Jack, who served in the Air Force at Malmstrom until 2022 when he retired. He established residency in Montana before retiring at the end of 2022. After he retired, he opened up a restaurant in Great Falls, actively engaged in the business. He can take the lesser of half of his military retirement income, or all of the income he earned from running the restaurant. And this is because he was a resident before June 30th, 2023, and he was a resident before he started drawing his military retirement income. So on the flip side, we have Mary. She retired from the Navy in 2020, and she was a resident of Florida when she retired. She became a Montana resident in 2022 and operates a farm in Polson. Even though she's a military retiree and is operating a farm, she's not eligible for this subtraction because she didn't become a resident after June 30th, 2023, and she wasn't a resident before she started drawing on her military retirement. And finally, before we get into the changes to the Form 2, I just wanted to touch briefly on non-resident taxation. Non-resident taxation, for the most part, doesn't change. The determination of Montana source income stays the same, and it's still a ratio of Montana source income to income from all sources. However, we will have two ratios. So one is going to be for ordinary income, so all that income that's not a net long-term capital gain, and then the other one's going to be for net long-term capital gains tax. So here we're going over the Form 2 with the major changes out of the way. We had to really, with the major changes made by the bill, we really had to change the Form 2, so it looks a lot different than it has than it previously did. One thing to note, we broke out the form into separate schedules. This is much like the federal system. So when filing a tax return, a Montana tax return, taxpayers are only going to include the schedules they need to report items on. So for a taxpayer that has a Montana medical savings account only, they'll send in pages 1 and 2 of their Form 2, and then they'll also send in their Schedule 1, which reports the Montana adjustments and the medical savings account information. We've also included items that are frequently claimed on page 1. So like I was saying before, with that $5,500 subtraction for taxpayers 65 and older, that's going to be on page 1 rather than our adjustment schedule, Schedule 1. And this is just to reduce the amount of pages needed to file your Montana tax return. The tax liability is calculated on page 2. And previously we had a separate schedule for that, and that was called the tax liability schedule. This is now where you'll calculate your income tax. It's going to figure out what your ordinary income tax is. It's also going to be used to figure out what your net long-term capital gains tax is. Non-residents and residents complete this However, non-residents will stop at line 12 and they'll transfer lines 11 if they have a capital gains tax, in line 12 to their specific schedule, which will be Schedule 2. Here's a look at our Schedule 1. This is the adjustment schedule. And previously we had an addition schedule, a separate subtraction schedule, and a separate medical savings account schedule. We combined all of the additions, subtractions, and the Montana medical savings account onto one schedule. Part 1 of the schedule reports the adjustments. So this is your additions and your subtractions. And then Part 2 will be used to report your Montana medical savings account adjustment. Here's a look at the Schedule 2. This is our tax on Montana source income schedule. Previously, non-residents and part-year residents reported their Montana source income and determined their non-resident part-year resident ratio on the non-resident part-year resident ratio schedule. This information, along with actually the determination of their taxable of their Montana tax, is going to be completely on Schedule 2 now. And you can see on the bigger image, we've got the ordinary income tax and the net long-term capital gains tax there. Another thing you might notice is that spouses with different states of residency, so we've got a resident filing jointly with a non-resident or a part-year resident, they're going to have to file Schedule 2 if they file jointly federally. And this was the resident will report all of their source income, all of their income, sorry. And then the non-resident or part-year resident spouse will include any Montana source income along in that calculation there. Schedule 3 is used to report our non-refundable and refundable tax credits. Previously, non-refundable and refundable tax credits were reported separately, with our non-refundable credits being reported on a non-refundable credit schedule and our refundable credits reported on the other payments and refundable credit schedule. We just combine them and have one schedule for that. Also on the Schedule 3, that's where taxpayers are going to calculate their credit for taxes paid to another state. And the credit calculation has changed because we have that new net long-term capital gains tax. So if a resident ends up having paying tax on a net long-term capital gain in another state, they'll have to separately figure the credit out for that capital gain they paid tax on in that other state. Schedule 4, that's used to report our checkoffs, our penalties, interest, and we also threw in the various other taxes that we have in Montana, our recapture tax and that lump sum tax. And then we have a separate schedule for amending a tax return, that's Schedule 5. Previously, that was on page 2 of the Form 2, kind of hidden at the bottom. And then our last schedule is the Schedule 2EC, and this is for our elderly homeowner renter credit. This was previously on the elderly homeowner renter credit schedule. You'll see that the schedule is significantly changed. Under the gross household income section, we had to expand that because we no longer get all of the items of income that would have been included that's required to be reported as part of gross household income. So we had to expand the schedule to report all of the items that are included in the gross household income. Of course, lines 1 through 15, those items were previously reported on the Form 2, those with us reporting only federal adjusted gross income now, those we no longer get a picture of those. So That's why it's broken out like that. Also, the credit calculation and the amount of the credit did not change, just the reporting of the credit. With that, I'm going to turn it over to Brian to go over our remaining topics.
Sorry about the delay there. I've been trying to help with some of the questions and got sidetracked on that. With estates and trusts, that their simplification applied to that as well, and that it's already started pretty low on the, as far as close to taxable income. We're a lot closer with that, and then the impact of repealing some of the additions and subtractions that may have trickled over to estates and trusts was the same effect was there. So it's a lot shorter in that. They do use just a single rate. It's just the single rate for, excuse me, let me clarify that. The rate that a single taxpayer would use those rates tables. And they do get the capital gains rates in that, in the case. There still could be, because of some of the additions and subtractions, a little bit different distribution deduction. And so you will recompute that. But it's not quite as likely to be a big difference in that. Pass-through entities, we could give you 2 hours on a discussion on pass-through entities and the new changes in that. Simply put, for the purposes of this presentation, the withholding and the new PTET, the pass-through entity tax, those are simply at the highest rate in that. Composite tax, the impact of simplification was to say that we do use you would use the rates that apply to single filers, and that you get the federal standard deduction for a single filer on that case. You would not be able to use these capital gains rates for these computations of, say, the composite or the pass-through and all that sort of thing. So the PTET. So that may be a reason to how you would adjust some of your schedules. With the next slide, because of the change for going from following the option of having married filing separate and the different place you started with computing your income, some taxpayers may have some existing differences in things like passive loss carryovers or suspended passive losses or capital losses. The bill provides for a one-time transition to report the difference essentially and play, kind of call it catch up. It's not a very common thing based on my experience. If we have more than 200 filers with these sort of adjustments, I'd be amazed. But again, it would be if you've got any of these differences and losses and you have the paperwork to support it, the old returns, the old schedules and the information behind that, you can certainly claim one of this adjustment. This is also if you had something that you could show a difference in basis. So that is part of the one-time 2024 adjustments in that. So, and you'll see on that adjustment schedule, that is where you report your taxable federal refund. It's kind of a transition item because, as we've kind of alluded to earlier, we no longer have a federal income tax deduction going forward. And so any addition because of a refund is just essentially going to be a one-time thing on that schedule in that. So the next topic we wanted to kind of talk about on the next slide, the first-time homebuyer and farmers management accounts, the subtraction for contributing to those was repealed. However, those accounts, if you had that established, are still valid, and you would need to, you simply need to follow the prescriptions of the previous law that said that you use the funds within a given period of time. So it's 10 years from when the first-time homebuyer account was opened is when you need to purchase your new home. And 3 years is from when you made a deposit is when you would need to make the withdrawal from that account for whatever, for the purposes in that. Somebody had asked earlier in the Q&A about medical savings account. Those still exist. They tweaked it a little bit, but it's still essentially the same thing in that. So with that, I think I'll kick it back to Rachel one last time for any sort of wrap up, and maybe we can get some clarity. So.
Yeah, thanks, Brian. So this last slide is resources for you to go out and take a look because we only have a limited amount of time here. So I've got the resource out to our Montana Simplification Hub. This is a comprehensive website that includes all the details on the new bill, on the new system. You'll see that we've got a basic descriptor there of the bill and the changes. We also have a link to our draft form 2 along with all the draft form 2 schedules. We also have some FAQs out there, some questions that we've received, as well as just questions we received over the course of just implementing this bill. Got links to Senate Bill 399. Again, that's the bill that changed the tax system. I've got a link out to the Senate Bill 550. That was passed this last session. It made minor changes, and it may also be useful for you to look at if you're interested. Also have links. The next 3 are links pertaining to tax withholding. And that first one is our Montana W-4, basically. It's the federal component of the federal, or it's the Montana component of the federal W-4. This is what you use to tell your employer how much you want withheld from your paycheck. We are encouraging all employees to go out, take a look at what their withholdings are, make sure that you're having enough withheld from your paycheck, because we have changed how your withholding is calculated for from your employer, because we are starting with that federal taxable income amount with adjustments level. So take a look, make sure that you've got enough withheld. If you have questions about how much you need to have withheld, or what amount is set to be withheld, take a look at that employer and information agent guide. And then we also have out on our website this handy dandy withholding calculator. We have it set up for you to enter in the amount of income you expect to receive during the year. And then you can use that to determine if you're having enough money withheld from your paycheck. Finally, I have links at the bottom to the draft form 2 and all of the schedules. So you can take a look at that and go through and run some numbers for yourself if you're interested in doing that, or if you're just interested in general and looking at what Montana taxable income will look like. So we have a few minutes for questions. It seemed like we got a lot on the working military retirement exemption. So I'm going to just briefly touch on that one more time. There's a lot of details there. We'll be releasing that working military retirement form, the form WMRE, at the end of the tax year. We have a pretty comprehensive description of the bill, of the subtraction out on our website. But this new subtraction, so this is for military retirees that basically are working. The subtraction is equal to half of the lesser of half of the military retirement income, or all of the Montana source income from working a job, working a job, actively running a business, or farming. So if you're not working a job, but you have military retirement, we're going to take the lesser of half of your military retirement, or the income you make from working a job, running a business, farming. So if you're retired and not working, you're not going to get the subtraction. All right, we did have a lot of questions on the $5,500 subtraction for folks over the age of 65. Now, just this is for 65 and over, $5,500, blanket $5,500. If you and your spouse are filing jointly and you're both 65 and over, you both get the deduction. However, if you're married filing jointly and only one spouse is over 65 and over, you only get the $5,500 deduction. So the deduction of $5,500 is per taxpayer that's 65 and over. And finally, with the new, with the update to the tax form, the Schedule 2 EC, this is, you do have to file a Montana tax return to claim the credit. However, we will have the ability to file the Schedule 2 EC out on our website as we have had in previous years. Just note that if there is a federal filing requirement, taxpayers will have to file the Form 2. The standalone filing on our website is just for those taxpayers that are filing only for the tax credit. They don't have a filing requirement. All right, with that, we're going to go ahead and wrap up. Again, this webinar is being recorded. Jason's going to put it out on our website in a couple days or so. We're going to send out a communication to everybody that's on our newsletter list that it's available. You can go out and listen to it if you have, if you want to listen to it again, or you have colleagues that may have not been able to join us today. With that, I really appreciate everybody attending and learning as much as possible about the new tax law. So thank you.
Awesome. Thanks, everybody. And we'll wrap it up, and we'll see you next time. Also, find us on any of the social medias that we have. So find us there and you can get the latest, greatest. Rachel, thank you so much for delivering all this. And our back end, Logan, Brian, thank you so much. Brian, thank you for presenting. And we'll see everybody later. And keep an eye on what webinars we have coming out. And it'll be great to see you on the next webinar. So thank you so much for attending. I'll wrap this up. Thank you.